Welcome back to the channel, everyone. If you're preparing for your R06 exam, you're in the right place. In today's video, we'll be revising key concepts from Chapter 4, Analyzing the Client Situation, an essential step in financial planning. This chapter focuses on how to assess a client's financial position, income and expenditure, assets and liabilities, and risk factors to create a solid foundation for tailored financial advice. Before we begin, this video is a revision tool designed to help you recap key points. It is not a substitute for the in-depth CII study text, which provides more detailed explanations and examples. To craft a robust financial plan, we need a comprehensive understanding of the client's current financial standing. This involves delving into their income and expenditure patterns, analyzing their assets and liabilities, and assessing their risk profile. Just like a doctor needs to understand your medical history, we need a complete picture of the client's finances. This information is crucial for identifying potential financial vulnerabilities and opportunities, ultimately guiding us in developing a tailored plan. Understanding a client's income sources is fundamental to financial planning. We need to know where their money comes from, how stable those sources are, and how they might change over time. This analysis goes beyond simply looking at their payslip. By meticulously analyzing each source, we can assess the client's overall income security and identify potential vulnerabilities. This, in turn, influences our recommendations for budgeting, savings, and investment strategies. Expenditure analysis. Understanding spending habits. Now that we have a grasp of the client's income, let's turn our attention to their expenses. Analyzing a client's spending habits is like piecing together a financial jigsaw puzzle. Understanding the client's spending habits allows us to identify areas where adjustments can be made to free up cash flow for achieving their financial goals. It's not about restricting their lifestyle, but rather about empowering them to make informed decisions about their finances. Unraveling net worth assets, liabilities, and what it all means. Now that we've delved into income and expenditure, let's shift our focus to net worth. In essence, net worth is a snapshot of a client's financial health at a specific point in time. Understanding a client's net worth provides valuable insights into their overall financial position and their progress towards long-term financial goals. In the following sections, we'll break down the components of net worth, exploring assets and liabilities in detail. Asset evaluation. Taking stock of what you own. Assets are items of value that a client owns, representing their financial resources and potential for generating future income. These can range from tangible assets like property and vehicles to intangible assets like investments and pensions. When assessing assets, it's crucial to consider their liquidity, how easily they can be converted into cash. We also need to consider their growth potential, how likely they are to increase in value over time. By carefully evaluating each asset class, we can gain a comprehensive understanding of the client's financial strengths and their potential for building wealth. Delving into liabilities, understanding financial obligations. On the other side of the net worth equation, we have liabilities, financial obligations or debts that a client owes to others. These can include mortgages, credit card debts, student loans, or even outstanding bills. High-interest debts like credit cards can quickly erode net worth, while low-interest debts like mortgages might be manageable with proper planning. Understanding the nature and scope of a client's liabilities is essential for developing effective debt management strategies. Calculating net worth, the equation of financial standing. Now that we've explored the building blocks of net worth assets and liabilities, let's put it all together. By subtracting total liabilities from total assets, we arrive at a single figure representing the client's net worth. A positive net worth indicates that their assets outweigh their liabilities, suggesting financial health. However, net worth is not merely a static number. It's a dynamic indicator that fluctuates over time based on income, expenses, asset performance, and debt management. Decoding debt types, terms, and impacts. In the previous section, we explored the concept of liabilities as a crucial component of net worth. Now, let's delve deeper into the world of debt, understanding its various forms, characteristics, and potential implications for a client's financial well-being. Debt, in its simplest form, is money borrowed from one party to another, with an agreement to repay the principal amount plus interest over a defined period. However, like any tool, debt can be misused, leading to financial strain and jeopardizing long-term financial security. We need to consider factors like interest rates, repayment terms, and the purpose of the debt to assess its impact on a client's overall financial health. Assessing debt sustainability. Can the client manage their obligations? Once we have a clear picture of a client's debt portfolio, the next step is to evaluate their ability to manage those obligations effectively. This involves analyzing their income, expenses, and overall debt burden to determine if they can comfortably meet their repayment requirements without jeopardizing their financial stability. We can use various metrics, such as the debt-to-income ratio, which compares total monthly debt payments to gross monthly income, to gauge their debt sustainability. By carefully evaluating their debt sustainability, we can identify potential red flags and recommend appropriate strategies to mitigate risks. Debt management strategies. Navigating the path to financial freedom. Managing debt effectively is crucial for achieving long-term financial well-being. Debt management isn't a one-size-fits-all approach. It requires a tailored strategy based on the client's unique circumstances, risk tolerance, and financial goals. For some, it might involve consolidating high-interest debts into a lower-interest loan to reduce monthly payments and save on interest costs. The key is to empower clients with the knowledge, tools, and support they need to navigate the complexities of debt and achieve financial freedom. Identifying vulnerabilities, recognizing potential financial risks. In the world of financial planning, it's not enough to simply analyze a client's current situation. We also need to look ahead, anticipating potential risks that could derail their financial well-being. These risks can range from personal events like illness or job loss to broader economic factors like inflation or market downturns. By identifying and understanding these vulnerabilities, we can begin to formulate strategies to mitigate their impact and protect the client's financial future. The role of protection planning. Shielding against the unexpected. Once we've identified potential financial risks, the next step is to develop a robust protection plan. This involves putting measures in place to mitigate the financial impact of those risks, ensuring that the client and their loved ones are shielded from potential hardship. This might involve establishing an emergency fund to cover unexpected expenses, securing appropriate insurance coverage to protect against specific risks, or even developing a contingency plan for income replacement. The goal is to create a comprehensive strategy that addresses both short-term and long-term risks, providing peace of mind and financial stability. Insurance, a safety net for life's uncertainties. Insurance plays a pivotal role in protection planning, acting as a financial safety net that safeguards against the financial consequences of unforeseen events. There are various types of insurance, each designed to address specific risks. Life insurance, for example, provides a lump sum payment to beneficiaries in the event of the policyholder's death, ensuring financial security for loved ones. By carefully assessing a client's needs and recommending appropriate insurance coverage, we can help them navigate life's uncertainties with greater confidence and financial security. Tailoring protection, creating a personalized safety net. Just as every client's financial situation is unique, so too are their protection needs. We need to consider factors like age, health, dependence, lifestyle, and financial goals to determine the most appropriate level and type of coverage. For a young family with a mortgage, life insurance and income protection might be paramount, while an older individual might prioritize critical illness cover or long-term care insurance. By taking a holistic view of their circumstances and aspirations, we can create a personalized protection plan that provides the right level of coverage at each stage of their lives. Navigating the tax landscape is a key element of financial planning. As financial advisors, we don't just deal with numbers. We navigate the complex world of taxes, ensuring our clients keep more of their hard-earned money. Tax planning is not an afterthought. It's an integral part of the financial planning process. Our role is to help clients piece together the pieces in the most advantageous way, minimizing their tax liabilities while remaining compliant with tax laws. Effective tax planning is not about evading taxes, but rather about optimizing tax efficiency within the bounds of the law. Untangling tax implications involves understanding income tax, CGT, and more. The UK tax system, with its myriad of rules and regulations, can seem daunting. As financial advisors, it's our responsibility to guide clients through this intricate web, ensuring they understand the tax implications of their financial decisions. Income tax, a significant source of government revenue, is levied on earnings from employment, investments, and pensions. Understanding income tax brackets, allowances, and reliefs is crucial for optimizing a client's tax liability. Beyond income tax and CGT, we need to be mindful of other taxes, such as inheritance tax, stamp duty, and dividend tax, considering their impact on a client's overall financial plan. Maximizing tax efficiency is about making the most of the available allowances, reliefs, and exemptions to minimize tax liabilities legally. One strategy involves utilizing tax-efficient investment vehicles like individual savings accounts, or ISAs, where investment growth and income are tax-free. Another approach involves optimizing pension contributions, as these offer tax relief on contributions and tax-efficient growth. By implementing these and other tax-efficient strategies, we can help clients keep more of their hard-earned money, maximizing their financial resources for their desired goals. Charting the course: retirement planning and its significance. Retirement planning is not just about accumulating a nest egg. It's about designing a financial roadmap for a fulfilling and financially secure future. It's about helping clients transition from the workforce to a new chapter in their lives, ensuring their financial well-being throughout their retirement years. This involves understanding their retirement aspirations, when they envision retiring, where they plan to live, how they hope to spend their time, and aligning those aspirations with their financial resources. Retirement planning requires a long-term perspective, considering factors like life expectancy, inflation, and investment returns to ensure clients have sufficient income to maintain their desired lifestyle. It's about helping clients make informed decisions today to secure a comfortable and fulfilling tomorrow. Bridging the gap. Assessing retirement income needs and shortfalls. A crucial step in retirement planning is determining a client's income needs during retirement. This involves understanding their current spending habits, factoring in potential changes like reduced housing costs or increased healthcare expenses, and adjusting for inflation to project their future income requirements. Once we have a clear picture of their income needs, we can compare that figure to their projected retirement income sources, such as state pensions, workplace pensions, and personal investments. This comparison often reveals a potential shortfall, the difference between their desired retirement income and their projected income sources. Identifying this shortfall is crucial for developing strategies to bridge the gap, such as increasing contributions to pensions, adjusting investment strategies, or even considering delaying retirement. Lifetime cash flow projections. Visualizing financial futures. Lifetime cash flow projections are powerful tools that bring retirement planning to life. They provide a visual representation of a client's projected income and expenses over their entire lifetime, allowing them to see the long-term impact of their financial decisions. These projections take into account factors like income sources, investment returns, inflation, and even life expectancy to create a personalized financial forecast. By visualizing their financial future, clients can gain a better understanding of their financial trajectory, identify potential shortfalls or surpluses, and make informed adjustments to their plan. It's like having a financial crystal ball, albeit one based on careful calculations and realistic assumptions. Navigating uncertainty, stress testing retirement plans. Retirement planning is not an exact science. It involves navigating a future filled with uncertainties. That's why it's essential to stress test retirement plans, subjecting them to various what-if scenarios to assess their resilience. What if inflation is higher than expected, eroding the purchasing power of savings? What if investment returns fall short of projections, impacting the growth of their portfolio? What if they live longer than anticipated, requiring a larger retirement nest egg? By simulating these and other potential challenges, we can identify vulnerabilities in their plan and make necessary adjustments to strengthen its resilience. Stress testing is about being proactive, not reactive, ensuring that the client's retirement plan can weather whatever storms the future may hold. Estate planning is crucial for everyone, regardless of age or net worth. It's about managing your assets and ensuring your wishes are followed, providing peace of mind for you and your loved ones. Estate planning involves creating a will, establishing trusts, and designating guardians. Ensure your legacy is preserved and your loved ones are provided for. Inheritance tax is a tax levied on the value of a person's estate upon their death. Inheritance tax planning is crucial for preserving wealth and minimizing the tax burden on beneficiaries. Effective planning uses legitimate strategies to reduce liabilities and ensure more wealth is passed on. This includes using tax allowances like the nil rate band and making lifetime gifts. Placing assets into trust and making charitable donations can also help. Implementing these strategies ensures loved ones receive the maximum benefit from your estate. While financial assets form a significant part of estate planning, it's important to remember that a person's legacy extends beyond monetary value. A holistic approach to estate planning considers not only the distribution of wealth, but also the preservation of values, memories, and wishes. This might involve leaving behind letters of wishes to guide beneficiaries, documenting family history and traditions, or even specifying funeral arrangements to alleviate stress on loved ones during a difficult time. It's about ensuring that your legacy reflects your values, your passions, and the impact you've made on the world. By taking a comprehensive approach to estate planning, we can help clients create a legacy that encompasses their financial assets as well as their intangible contributions to the world. As we come to the end of this chapter, let's recap the key points we've discussed in our journey so far. We've explored the intricacies of financial standing, from understanding assets and liabilities to recognizing the importance of managing financial obligations. We delved into the critical aspects of financial planning, including navigating the path to financial freedom, recognizing potential financial risks, and shielding against the unexpected. Our discussion highlighted the significance of creating a personalized safety net, which is a cornerstone of sound financial planning. We also examined various strategies for financial optimization, such as tax planning and retirement planning, ensuring that you are well prepared for the future. Estate planning emerged as a vital component of preserving wealth for future generations. It's not just about the financial assets, but also about leaving a lasting legacy that reflects your values and contributions. A holistic approach to estate planning ensures that your wishes are honored and that your legacy continues to benefit your loved ones. By understanding these essential elements, you are equipped to make informed decisions that will safeguard your wealth and provide for future generations. Estate planning is more than a financial exercise. It's a way to ensure that your life's work and values endure, providing a foundation for those who follow. And there you have it. Now to summarize. Analyzing a client's financial situation is key to effective planning. This process is an ongoing dialogue. Life is dynamic and plans must adapt. Regular reviews are crucial. Ensure plans align with evolving goals. Remember to join us in the next video as we delve into Chapter 5, Formulating Suitable Short-Term Planning, including current cash flow planning, such as liquidity and short-term savings, debt management, loans, mortgages, and equity release solutions, protection planning, life and health insurance, redundancy and unemployment protection. Thank you for joining us on this journey. Remember to like, comment, and subscribe. Until next time, happy studying and best of luck with your exam.